We have Gautam Trivedi, managing partner at Nepean Capital, right here with us in the studios. Gautam, great to have you in.
Thank you.
So much the market has had to digest, from wars to trade wars to, short seller reports and, so on and so forth.
Yeah.
But, I want to then, the whole thing is regulatory action back home as well, this whole Jane Street saga. I want to start just right there to understand whether what we are seeing in the last few sessions, this last 1 week where the market's gone so quiet that the index barely moves 10 points in a day. And is it just a lull before earnings and further news flow? Or do you think that this overall Jane Street / HFT crackdown of sorts, whether that will have a part to play in just the near-term trading action?
Yeah, I think the impact of Jane Street seems to be limited more to the futures and options market, not so much the cash market. And if you look at the, I agree with you that the market's been sort of flattish for over about 10 days now or so. But I think earnings is really what's going to, people are waiting to see which way to drive the market from here on, given earnings. Given the fact that our first quarter earnings were actually pretty dismal. And if you drill down even further, I looked at the numbers actually last night. And I found that the fourth quarter consolidated the Nifty 50 numbers were actually still very, very weak. I mean, PAT growth, and again, I'm talking of consolidated because some people like to slice and dice by saying X financials, X OMCs.
X oil and gas.
Exactly. But if you look at a consolidated Nifty 50, PAT growth was a mere 0.8%, so less than 1% PAT growth. And even for the full year, FY25, the PAT growth was a mere 5.5%, which apparently is a 4-year low.
Yeah.
So given this, I think, on a short-term basis, given that the earnings season kicks off later this week into next week and then so on, I would wait to see what the numbers are before incrementally putting more money in the market.
The only thing is, I think we're going in with the season with fairly, solid expectations. Because the mood in the market is that we've seen the trough and it just gets better from here. So, estimates ranging between 11% to some of the optimistic ones to 13% earnings growth this year. Do you think that'll play out?
It seems a little challenge at this point because we do start off the fiscal year every year for the last few decades with an extremely high, aggressive...
It's a ritual.
It's a ritual.
Start optimistic, always.
Optimistic, exactly.
Tradition means something, right?
Start on a hopeful note.
No, but having said that, I mean, I hope that the transmission of the 50 basis points repo rate cut starts to happen with the banks. September, we'll see the CRR cut, more money flooding the market. So hopefully all of that should play out and help the Indian economy.
Actually, the crazy thing is that every quarter, if you look at the expectations this quarter, they're very muted. But then if you look at year is made up of 4 quarters, right? Yeah. But if you look at the annual earnings growth, that is still, as you said, reasonably rosy. But quarterly, if you look at it, it's always very challenged and expected. I mean, look at, is there any sector, if you just look at this quarter, where you think we'll see very good earnings growth? Banks, 30% of the market, NIMs will fall this quarter, next quarter.
That's right.
IT will get hit, TCS. I mean, we're talking about CC decline. We're talking about the extent of the decline. 1.5% could it be larger?
Yeah.
FMCG.
Not happening,
Low single digits, as they always say.
Don't want to sound all dire in the morning.
Thanks, huh? I think the earnings downgrade's happening here right now in the studio itself. Let's not even wait for the analysts on the results.
But it's been like that, Gautam, right? I mean, there are obviously shining stars within each sector.
Yes.
I mean, for example, in IT, there is Coforge. So there is stuff which does well.
No, but for that matter, in QSR, there's Jubilant, right?
Yeah.
Everything else seems to be either single digit or negative same-store sales growth, but Jubilant seems to buck the trend quarter after quarter. So, yeah, you're right. There are certain... even for that matter, let me put it in terms of the shoes category. If you look at Campus, you look at Bata, you look at Relaxo, all struggling. But then you have Metro, on the other hand, who's doing extremely well.
So I read wires and cables. They could do well this quarter. I don't know. Do you look at that space?
No, we do, of course. But again, that's probably having a moment like paints where you're seeing big players coming soon. Not yet, but coming soon, So that's starting to get discounted in the price.
Gautam, since you mentioned Jubilant Foodworks, the report was very, very good, the quarterly update. But how much of it is in the price? That's the problem. Because on the day that they declared it, the stock actually ended down 3.5%. And most sell-side reports that I saw suggested it was good. And even I went through the fine print, it looked pretty good. So your view on that? How much of some of this good news is already in the price?
Well, Jubilant's always been an expensive stock versus the others. So I'm not really concerned about the valuation.
You'll still continue to remain positive on it?
I would remain positive because it seems to be the only, shining light within the QSR space.
Okay, just coming. Now, Dream folks, this, I don't want to talk about the stock per se, I don't know if you have a view even, but what do you make of the entire sort of, it kind of, not in a straightforward way, but talks about, the lesser talked about variable in every sector, which is the big, the competition risk in that sense. Here, of course, it's disintermediation, if I can call it that.
That's right.
But any thoughts at all here?
But I think that what you're saying is true. No matter what sector you're in, there is disruption, and if it's not from competition, it's either from technology or AI that's coming in as well. And I think the IT sector in particular is vulnerable to that. So yeah, that's a real problem in this country. I mean, you could have an irrational player come in and actually damage the industry and take away market share, and survive for several years before cleaning out the competition.
And this direct quick commerce, I mean, just to sort of hop from again. This, I thought of it because of competition again, right? Zepto, for example, yesterday said they're raising money.
That's right.
More money. Any
at a higher valuation.
At a higher valuation. So.
No, I think quick commerce is here to stay. I mean, our view is, my boys don't order anything anymore. They haven't been to a Kirana store ever, I think. I should probably drag them out of the house once and take them. And this is what a real store looks like, not the one on your phone. But the fact is that, it's here to stay. And people, I think, are having less and less patience, whether it's short reels that's causing that to happen, or it's the OTT platforms. But people want instant gratification. So if you order a toothpaste, you want it in 10 minutes. You don't want to wait an hour for it.
The reels are the biggest disruption, I think, for mankind in general, at several levels.
Good for customers, good for shareholders as well?
Shareholders of Zepto or
I mean, the entire space, Zepto, Eternal, Swiggy, do you think? Because I'm very, very happy, using the services.
Yeah.
But as a shareholder, would you say that the better time's coming for them?
Yes, because they are taking away significant market share from the Kirana stores.
Yes.
The Kirana stores, of course, there will be some political ramification at some point when they say that, these guys are hurting. They are already hurting, but maybe they hurt even more before somebody takes up their issue. But the reality is, they're here to stay. So probably definitely good times. But specific on Eternal or Swiggy, the competition is so intense, much like the paint industry, where you're seeing large organizations, large industrial houses getting into the business. I don't see how the economics necessarily will continue to be strong.
So, Gautam, now put it all together for us. And we haven't discussed the global backdrop, which is amazing because you look at the US market, with wars and with so many headlines, tariffs, it's just going up and up, at least for now. That so-called, great gush of FII liquidity doesn't seem to be making its way to our market anytime soon, at least on a more durable, permanent basis.
Yeah.
Coupled with everything that we've discussed, earnings expectations are low, valuations are high. So what should an investor be doing here in India?
So let's understand what's driving this market. It is pure fund flows, okay? And you got to hand it over to the Indian domestic investor, continue to put money month after month after month. I mean, yesterday's number was, I think, a big shocker to me personally.
23,500, yeah.
Well, that was the net number, but the SIP was 27,300.
Yeah, SIPs were fantastic.
So that's obviously a new record high.
Yeah.
So let's see what's driving that and pertains to what's happening back in the States. If you look at here, you're looking at extremely low savings rate. HDFC's, and I have an account with HDFC Bank, their savings rate is 2.5%. Fixed deposits, 1 year tenor down to 6.25%. So would someone like me be incrementally putting more money in the equity markets? Probably yes, to try and beat fixed income returns. Secondly, if you look at the average age of the investor, I was looking at the NSE Market Pulse, and they have some pretty interesting raw data in there. 40% of the investor base, unique investor base, is below the age of 30. 70% is below the age of 39. If you look at the top 5 states, Maharashtra, Gujarat, UP, and Rajasthan, and West Bengal, this is where the top, about almost 50% of the unique investors come from. If you look at incrementally, where are the new investors coming from? Include states like Tamil Nadu and Bihar. So the equity culture has only just started. I mean, there's more to go, more states to hit and penetrate. So I don't see that slowing down from India perspective. As far as the US is concerned and FI participation is concerned, the fact is our market's trading at the same valuation as the S&P 500. FIs, when you look across Asia, for example, you got earnings growth that matches ours across Korea, Taiwan, and China for this year. So we're not cheap. FIs have more options to invest in, and the earnings growth back home in the US is huge.
Yeah.
First quarter, calendar 24, S&P 500 earnings grew. All 500 companies' average earnings grew by 12%. And that's 28% for the Max 7, 9% for the balance 493 companies. So that's huge earnings growth, and we don't have that here.
Yeah. Explains a lot. So what should one be doing? I mean, in terms of, like you said, as investors, I mean, we need to be in the equity market for the reasons you just mentioned.
That's right.
But we have all of these headwinds. So where should that money be put?
Money still can be put in the equity markets. Doesn't seem to be an alternative. I mean, gold's the other option in terms of an asset class.
Where in the equty market?
So here's the thing. I know you're going to pin me down on that, but the reality is, of the 1,200 stocks, we ran the screen only last week, of the top 1,200 stocks by market cap, 890 stocks over the past year or so are up 25% or more, which means 300 stocks have underperformed. Second, and more importantly, if you look at over the past 2 to 3 years, there are total sectors that haven't performed at all. I mean, we discussed shoes, we discussed QSR, with the exception of 1 or 2 companies that have actually done well. I mean, even TCS over the last 3 years has given us mere 6% return. So there are a lot of sectors out there that haven't done well. And I think the other element to look at are companies which are undergoing a special sit. So we run a public market fund, which is a special sits fund. So you're looking at Ps getting into in terms of ownership or taking chunky stakes. We've seen a lot of that happening over the past several years. You're seeing promoters sell out. That's a big theme. M&A happening in the industry. So there are a lot of chunky things, deleveraging happening. So there are a lot of opportunities that are actually there, but you got to roll up your sleeves and find them.
All right. Gautam, final question from mine before I let you go. I recall being at a cement plant to visit more than a decade ago, and you happened to be there as well. I think I was the only business journalist that managed to sneak in there.
Yeah.
And the street is optimistic. The second half of the year is going to be better for cement companies. And, to be fair, price increases is something that's been good. That's been the lone positive. Hopefully, demand catches up as well.
Yeah.
What's your view on this theme? And do you believe some of these smaller cement players or the ones that have underperformed in South India are better placed?
Yeah, so I think cement's a very regional business. So South India traditionally has not been best in terms of pricing power.
Absolutely.
We haven't played a cement theme as yet. We played it more through construction companies and other ways to play cement. But is the horizon bright? I think the horizon is indeed bright, but it's not going to be, EMS.
So that's not one of your preferred sectors.
It's not a great preferred sector as yet, but it's not going to have great earnings growth. But I think there's consolidation happening, and hopefully that's going to give it even more pricing power.
All right. EMS, you just briefly mentioned that. That's a theme that you've liked in the past. It has a big runway ahead. Valuations, it's debatable where exactly the stocks are at. But would you be looking any kind of bad news to buy into some of these names? Stocks like Dixon, you've had various contradictory reports in the last couple of months.
Yeah.
Some very positive, some very negative. But, 1,350 odd, where the promoter offloaded some stake, that seems to be the zone. It goes there, it bounces back very quickly. Your take?
Yeah, my view is not specific to Dixon, but my view is that EMS is a growing industry. You're still seeing Dixon as an example, giving 80 to 100% quarter-on-quarter top-line growth.
Yes.
So my view is that this is an area one needs to remain invested in. Will the valuation sustain? And that's really something you got to think about. 70 times, 80 times. Some of the other names which are tier 2 versus Dixon are trading at half the valuation. So those are interesting too.
You want to name a couple of them? I think Sirma is one stock that we had discussed in the past.
We don't own it anymore. We own Amber, so that's something we're building a position in, so full disclosure.
Okay, all right. So some ideas finally. See, Nigel managed to pin you down.
I know.
Let you go.
Drinks on me.
Thank you so much,
Thank you.
Gautam. Great conversation, and thanks so much for stopping by at the studios this morning.